Hello, welcome to the second part of our macroeconomic overview. In the first section, we talked about global trends, we talked about disruptors, and the impact on the future. We're now going to take a moment and look at economic growth, measurement. There's many ways that we can measure growth. There's different indicators. There's thousands and thousands of indicators of what's going on in the economy. Some of them very minute, measuring very small things, but they all come together. And for our purposes, I want to focus on some of the key measurements that we use across the globe. One is the gross domestic product, and it's a primary indicator of the health of the country's economy. Now, everybody's taken the basic economics classes, so this should be a review for you. But I want to point out a few key things as we're going through as to how do they impact the business as a whole. How do these things impact decisions made by a company, not just financial decisions, capital allocation decisions, but people decisions? So it's a basic indicator of the health of the country's economy. If it's healthy, it's growing, we have a situation where we have low unemployment, wages increase as businesses oftentimes struggle to find new workers. We're seeing that very much today. It builds confidence. People feel good about themselves, and when they feel good about themselves, they tend to spend. However, if it's growing too fast, inflation can be a risk, meaning prices are rising rapidly along with wages. Because companies, if you think about it, can only absorb so many cost increases before they have to pass that price on. So if you have a shortage of labor, companies are going to have to pay more, which will cause prices to go up. That's a healthy economy. You want that balance. Then we have negative growth. And with negative growth, there's less jobs, less production, and it creates a negative feeling. And negative feeling impacts spending. Technically, 2/4 of negative growth is a recession. Now let's just take a look at it on a very macro basis. There's total GDP, which represents the entire production of a country or a geographic area. It's often expressed as a comparison to prior year or prior quarter. It can be an annualized number, but trends are most important. As I said earlier, that it's very complicated, includes statistics and estimates that come together. It's not always timely. There's a preliminary and final, which is the revised. So we have the preliminary right now for the first quarter ending March 31st, but we don't have the final. So there will be some revisions. Why I put this up is, one, to give you a sense of what is the size of the U.S. economy. This is an annual rate. So if you look right here, in the first quarter, we had gross domestic product of $21 trillion. So now, as you can see, that from first quarter 2018 to 2019, we've seen a growth of just about $1 trillion. Okay, but key things for you to know. There it is. This is right here, the personal consumption expenditures, 14,251. Almost 2/3 of our economy is driven by personal consumption. That's goods and services. That's the biggest piece. So whatever the consumer does impacts the whole. Relative size. Here we can see gross domestic investment, which is companies making investments in the future to produce goods that go into personal expansion in expenditures. Then we look at net exports, goods or services, and we can see that it is negative. So compared to where we were, we're down slightly, but that includes exports where we sell abroad by $2.5 trillion, and we import $3.1 trillion. So we have a deficit. But I want you to keep this in mind. This deficit here is really relatively small compared to the total number. And remember, it's both imports and exports. We'll talk about that in a little bit. Then we have, what is the government spending? And as you can see, the government is spending more and more. So some of the growth in the economy is coming because the government is spending more, primarily on defense. So national defense comes in and it's growing. So this is what the makeup is. What you should know is what the key components are: personal consumption expenditures, gross domestic investment, net exports, and government consumption. All of these things work together to produce the GDP. Now, if we look at this on a point in time basis, and I set out this chart that I made from 2001 through the first quarter of 2004, 2019, what we can see is there's a lot of variation. Can be trends, but if you look, it goes up and down quite a lot. So here was the Great Recession. You see 2007 through 2009, we had 4 quarters that was negative growth. We popped back up, down, up, down. So you can see there's a lot of variation. I don't know that we can always understand what happens when, okay? But there's generally events associated with this. So we can see that it is generally positive, and over almost the past 20 years, we have seen positive growth other than these small times. This was right after 9/11. This was the Great Recession. So we can see that it's a percentage change, and that's what we're looking at. If we can see, we've seen a change of about 3.2% in the past quarter. Now, when we break this down into a little bit more what's driving it, we can see the blue is the total. But we can see that if we go back here to 17, the consumer has been the biggest contributor to the economy. But look at what's starting to happen here. We're seeing consumer spending less. We're seeing some domestic here, net exports some, and government expenditures. So what started to happen over the past year or so is the consumer spending has slowed down. And that's the biggest piece. Now, what is the current view of where we're going? And right now, this is from Goldman Sachs, based on information from the Department of Commerce, here's the real GDP growth. That mirrors pretty much. And this is their current activity indicator that Goldman Sachs does. And now there is a forecast. So as you can see, it has the economy slowing down to just about 2%. And we'll talk about some of those factors, but it's going to slow from where we are today, about 3.5%, down to 2% as we get moving along further. In fact, we'll actually see some of that starting to happen by the end of 2022. Now, there's a lot of data that supports why that's going to happen. We're going to talk about some of them as we move forward. Here is the International Monetary Fund. They do projections worldwide, and the most recent one they have is they're showing 3.15, 3.6 in 2020. But you see advanced economies, which is US, Euro, Japan, UK, Canada, and others, growing at about 2%, 1.7 next year. Important to note that they made projections in October, and in January they pulled them back, showing lower growth for the year. We then see emerging markets growing much more rapidly. So we see 2% for advanced economies, double that plus some for emerging markets. Keep this in mind that you have growth that's happening. So it's spread out around the world. We still see Asia, China, and India growing at 6.2 right here in 7.5. So we're seeing the emerging markets growing faster. Some of that is the impact of the global trends that we did talk about. The global outlook, and I got this out of Bloomberg, and what we can see is that the consensus continues to keep us right around that number, and you can see it by developed and emerging markets. So there's two different sources that are giving us some direction, a steady one. But think about this from the impact of some of the macro trends, and it'll make sense. especially considering the aging and the lack of workers that we're going to be seeing. We see today and will continue to be there. You can't have production without workers. Again, here you can see it again by country where they made their reduction in growth. We can see that China just a little bit, India just a little bit, but take Mexico pulling back, Eurozone, we've seen that in Germany. So we're seeing a cutback. And remember, the world is tied together. We're not independent of the world. I think we want to be cautious on using the GDP because it's reflecting on what happened in the past. And I think to some degree, we haven't seen that the GDP can capture the impact of technology, which is growing rapidly, and improvement in lifestyles of the population. And I think there's many other measurements that we could use because it's probably it's probably more not just economic, but it's environmental indicators, social indicators. So we need to be cautious using the GDP. Knowing what it is, it's a benchmark. It's something for us to put within context because it'll influence decisions made by the firm. We got to be careful of this forecasting and nowcasting. I get information every day. I get a thing from the Wall Street Journal that gives me in charts and graphs what's happening. And I get so much information that I'm trying to react to it, and that's probably not the right thing to do. But with all this information and the use of artificial intelligence and technology, we're able to understand some of this in more real time. So this is part of this change that we're seeing in technology. Let's move on to an important thing to everyone is employment numbers. When we look at the end of April and employment numbers come out the first Friday of the month. So what we have is the April numbers, and what we can see is unemployment was 3.6%. And we can see how that has declined if we come back here, right here. This was the height of the Great Recession, and we can see that we went from almost 10% unemployment way down. And sometimes we've seen some up and downs, but the trend is clearly down. Okay, but if you go back and look, we tend to have certain patterns that repeat themselves. Is once it bottoms out, it tends to go back up. This we refer to as cycle. Another key number is the civilian participation rate. Okay, this is the number of people who are actually in the workforce and or looking for work. So right now we're just under 3%, 62.8% of the workforce is in of the civilian population is in the workforce. So that includes, when you look at that, that's essentially telling us that 37% or so of the population is not in the workforce. 37%. That could mean that they're aged, they're not working because they're retired, and as we see this start to happen, more and more people retiring, this number will drop. This includes those that are younger, those that are in college because they're not in the workforce right now, not looking for work, and it includes those that are permanently out of the workforce, those on disability, but also those who just have lost hope. But as you can see, this number has dropped precipitously. Okay, so there's less people in the workforce. If there's less people in the workforce, that means the unemployment rate is simply going to come down. Think about it. So another important thing, one of the things, and this is good news for you, is when we look at the unemployment rate based on educational achievement, we can see that those with the bachelor's degree or higher have an unemployment rate of less than 2%. Some college, but we see basically those with the high school diploma are the ones that are least able to work, okay, the unemployment rates. Now, this would mean that not just, these aren't tradesmen, these are people who don't have a skill or a trade. So we can see that over time, and those with the bachelor's degree, even when we had the height of the recession, were just a little over 4%, while those that had no education, less than a high school diploma, was up at 16%. Those with a college, with a high school diploma and no college, we can see were again quite high. So this is really, really good news as to where we are. But you can see there's an educational gap here. So the more education you have, the lower the unemployment. The less education, the higher the unemployment. Right now, we're looking at job openings in the U.S., and we're looking at about 7 million jobs that are open. And when we look at this, 7 million jobs is a lot. Why do we have 7 million jobs unfilled? We don't have enough skilled workers. That is a broad category of skills. Some of that is education, some of it is technical. So that's what we have here with that, a lot of job openings. This is even more stunning is when we look at it by ethnicity. And when we look at it, we can clearly see a gap between white and Asians, Hispanic or Latinos, and blacks or African Americans. There is this gap that unemployment is low for certain groups, whether that be education or ethnicity. So we look at these on a global basis. Think about the trends that are happening. College education. Let's talk about that for just a brief moment. 4-year degree or higher. 1977 when I graduated, 34% of the American people. What do you think it is now? Write a number down. Think about it. Now it's only 38%. By state it varies from 28 to 50. There's over 7 million unfilled jobs. So we haven't kept pace educationally. The same number of people over 40 years ago have that. When we look at those with a master's degree and higher, it's under 10%. And it varies by state. We're in New York State, which has a much higher rate. So you say, okay, that's great. Now let's just take a look at what that means from other countries. Canada, 56% of the population has a 4-year degree. Japan, 51. Israel, 50. Korea, 47. We could keep going. We're really at one of the least educated countries in the world. When we look at this and break it down a little further, I think this becomes important because of some of the social changes, social issues we have going on, is the participation rate between those that live in cities versus rural. As you can see here, that in metro areas, you're probably at about 64. When we get down into rural areas, we're just a little north of 59%. So what we see is we see more people not work in the workforce in rural areas. This is part of the social demographic changing. When we look at earnings, we can see again, there's a huge gap between wages. So if you have a college or professional degree, you're going to live in a city because look at what you're going to make. It's going to be significantly better, 51 versus 41. Yes, the costs are lower, but it's not going to generate the type of earnings that you may desire. So we're seeing this shift also, but we're seeing it as we break it down into education, race and ethnicity, and location.